Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Today, joining us on the program for our Palisade Sprott monthly market update is Rick Rule. Rick, it's been well over a month since we spoke last, and always a pleasure having you on the show.
The pleasure's mine, Colin, and by the way, congratulations on what was, by all accounts, a very successful conference at Jekyll Island.
Well, thank you so much, and hopefully at the next conference we can get you down there, Rick. Everybody would have loved to have seen you there. And speaking of conferences, you just returned from the New Orleans Investment Conference. I'd like to make short mention that Brian London will be hosting the 2018 Money Metals and Mining Cruise, of which you'll be a part of, and that's taking place May 28th until June 7th and should be a ton of fun. I'm sure it was quite an arm-twisting exercise to get you to join a 10-day cruise in Europe.
Well, Brian wisely proposed the idea to my wife before he proposed it to me, so accepting or rejecting was not an option open to me. I had accepted before I knew it was going to occur.
Very good, very good. Well, on to our discussion for today, Rick. Let's begin with gold stocks. And at the recently hosted Palisade conference, Matt Geiger, who you know well, brought to our audience attention a strange phenomenon, which is that 51% of all global exploration expenditures go just to gold, despite the fact that gold only makes up 15% of the recoverable metal dollar value coming out of the ground across all commodities. I want to ask you why it is that we, as resource investors, seem to allocate so much to gold, despite that small number.
I think it's a historical mistake. The paradigm that's present today in natural resource investing occurred in the 1970s when all commodities ran, but gold and silver ran most dramatically. Gold from $35 an ounce to $850 an ounce, and silver from $1.30 an ounce to $50 an ounce. The consequence of that was that investors in the natural resource space looked above any other factor to optionality to metals prices. And given that precious metals historically have been the most volatile in the resource sector, investors have looked for optionality primarily to precious metals. The second thing is that the narrative around gold and silver is simply more interesting than the narrative around, say, copper and coal. There's an allure and a history to gold that you don't see in other metals. But the truth is, the fact that you point out represents a flaw in investors' thinking. Much more free cash has been generated by commodities outside the gold sphere than in the gold sphere. And natural resource investors who focus on gold to the exclusion of other materials do themselves a disservice.
Rick, one might point to the fact that gold has actually performed quite well this year. So maybe investors' expectations are too high, but it seems that gold investors and gold stock investors are getting a little bit fatigued after having waited 14 months since that really nice rally ensued last year. What do you see unfolding there? Are we going to have several more months of this sideways pattern?
Well, that's a great big question, Colin. To begin with, your observation is correct. Gold has done well this year. It has maintained its investors' purchasing power. Interestingly, it's done well in an environment where the US dollar has done reasonably well too. Gold, as you know, normally trades inversely to faith in the US dollar, and the fact that the dollar has been at least relatively strong and gold has been strong simultaneously is unusual and encouraging. The point that you make about investors getting fatigued is not gold's fault, it's the investor's fault. The truth is that what gold is supposed to do is to maintain your purchasing power. When I came into the business, gold was at $35 an ounce. Now it's above $1,200 an ounce. Has it maintained my purchasing power? No. In fact, it's increased it. In the year 2000, the last cyclical bottom, gold was at $260 an ounce. Now it's at $1,200 an ounce. Has gold improved my purchasing power? Of course it has. The truth is that investors have expectations with regards to time that are unrealistic. The final point in the question that you made is that the gold stocks haven't kept pace with gold this year, which I think has to do with the fact that they did so well in 2016. The gold stocks needed a rest. But the fact that gold has outperformed the gold stocks, I think sets us up for a pretty interesting year in 2018. Maybe never good enough to satisfy the wildest aspirations of the speculators, but certainly good for people who are contrarian speculators to make a tidy sum in the market.
Rather than having a fluid discussion, since we only get you on once a month, I'm going to jump around a bit here. In regards to the battery metal space, first was lithium, then came cobalt, and now significant chatter about nickel sulfides. Robert Friedland's clean tech has been all the rave, and Friedland just put money in through HPX into Sama Resources. Some other nickel deals are picking up. Have you looked at the metal, and does it interest you?
Yeah, I like nickel a lot, not necessarily because it's a battery metal, but rather because there are impending supply shortages as a consequence of very low prices over time, and as a consequence of increasing enforcement of environmental regulations, both in Indonesia and the Philippines, that constrain lateritic nickel supply. And it isn't, frankly, the battery applications with regards to nickel that intrigue me. It's the fact that on a global basis, about 50% of sulfide nickel mines are uneconomic at current nickel prices. In other words, there's a whole broad range of applications that are important to nickel. Strangely, it seems to be moving on the sex, if you will, of batteries, ignoring all of the other applications that nickel enjoys. Moving backwards, my favorite of the battery metals is still cobalt. Cobalt is the first metal in my lifetime where the consumers of the metal say to me that if the supply of the metal were to increase, that the price could increase too. I've never seen that before. What the fabricators say is that they are delaying the implementation of cobalt in various fabrication applications because they're afraid of scarcity of supply from Congo and Russia. So ironically, if you increase the supply of cobalt, the price can go up. I've never seen a commodity like that in 40 years in the business, so I'm very intrigued about that. With regards to lithium, the demand for lithium has increased faster than the processing capabilities in the lithium industry have increased. We do not have a lithium shortage, a raw lithium shortage. We have a shortage of processing capacity, particularly of leachate lithiums. The world is not short of and will not run out of lithium in your lifetime, Colin, never mind mine. What we do have is a bottleneck in processing capacity. So if you ask me about the metals in sort of reverse order, cobalt, I think, is the one that still has the most dramatic upside. Ironically, the upside is tied to more, not less supply. I like nickel, not necessarily just because of the battery applications, but because it has a wide range of expectations, and the price of nickel right now is still low enough that you're discouraging new supply. The price has to increase, or the metal won't be available, and the metal is important for the lifestyle that you and I both live.
The venture exchange always seems to efficiently produce product, whether it's quality or not, and there's plenty of cobalt companies out there, but the dilemma is that cobalt, if it is served as a primary metal from a mine, seems to be from very small operations. How do you get exposure to cobalt? In terms of a pure play, the only thing that I know about is Cobalt-27, and outside of that, there's a hodgepodge of companies that have popped up with very small projects.
Well, that's highly challenging, and without going into exquisite detail, Sprott is doing a joint venture right now, a funded joint venture with Ross Beatty. More on that to follow, that will attempt to address that. But the discrepancy that you state is real in many senses. The producers that are important to cobalt are primarily copper producers or nickel producers. So while Vale is important in the cobalt business, Norilsk is important in the cobalt business, Glencore is important in the cobalt business, cobalt isn't necessarily as important to them. It's very difficult to get a pure play. And where you do get or will get something approaching a world scale pure play, it is very likely to be in Congo and Russia, two places that repel investors as much as the concept of battery metals attracts them. My own experience, Colin, going back 35 years, is that I will take political risk in order to avoid technical risk. In other words, I would prefer a tier 1 deposit in a tier 3 country as opposed to a Tier 3 deposit in a Tier 1 country. There is lots of cobalt to be found in northern Ontario, as an example, in the mafic and ultramafic sills that have been explored in the past for things like nickel. The problem is that the concentrations of cobalt, that is the amount of reserve and resource that has been found in past booms, hasn't been sufficient to develop even Tier 2 deposits. The big deposits of cobalt in the world occur primarily in Congo or Russia, or they occur as laterites, in nickel laterites, in places like Philippines, Indonesia, Brazil, and Australia. So it's going to be a real challenge finding a cobalt play that simultaneously excites the speculators and has economic breadth and width.
Rick, question for you, and I should have started the conversation on battery metals with this. I'm not sure what your opinion is on the electric vehicles outpacing petrol vehicles and reaching cost parity, but you would think that two metals would suffer from that happening, being platinum and palladium. On the other hand, platinum and palladium right now are trading at a discount to gold, which is historically low. So I'm wondering what your opinion is on those metals.
My suspicion is, except in some urban areas, that electric vehicles will never achieve cost parity, operating cost parity with gasoline. Gasoline's an extremely efficient fuel. That being said, if you add back a carbon tax and the politically correct nature of electric vehicles, the subsidies in place in every part of the electric vehicle value chain seem to mean that electric vehicles will get a larger and larger market share relative to gasoline vehicles. Where electric vehicles are highly unlikely to be competitive is in things like long-range transport. And in long-range transport, if you listen to the gurus at people like General Motors, one of the answers may be fuel cells, which, if it were the case, would greatly increase the consumption of platinum and palladium. What you need to understand, though, Colin, is that what you and I are talking about is something that's going to happen 10 years from now or 15 years from now. What really matters to the platinum and palladium market is simple. Will we begin to have a global sustained economic recovery that increases the number of vehicles sold? We have been since really 2008 in a constrained market globally for motor vehicles. And a more important question with regards to platinum is, will Chinese diesel refining standards improve? At present, the contained sulfur in most Chinese diesels is so high that when you crack or burn the diesel, the sulfur comes out in a very weak, very diluted form of sulfuric acid and eats up a catalytic converter. The consequence of that is that there's been no requirement to put catalytic converters on Chinese diesel vehicles. The Chinese government has said that particulate air pollution in China kills 500,000 people a year, and that high quality air is a policy consideration. If they do what they say they're going to do, which is clean up Chinese diesel standards, that would greatly increase the demand for platinum and palladium. Now, I have been reviewing this theme for 5 years, and thus far what the Chinese government has done is very different than what they say they're going to do. But the catalyst for higher, interesting choice of words, the catalyst for higher platinum prices, certainly in the near term, would be Chinese refining standards.
You recently put out a piece with Takoa da Silva talking about the bullish case for uranium, and being that the uranium price has been depressed for so long, I've had listeners asking me to maybe review more of the negative side of the case. Maybe you would agree that if uranium prices drop from here, it doesn't really matter too much because none of these companies are making money. What on the negative side of the picture, from a timing perspective, could really push this bull market off a while?
Well, I think there's 4 things that could happen from a negative perspective. 1, the tepid economic recovery that we seem to be experiencing worldwide could slow down, which means that demand for electricity could slow down. 2, Kazatomprom, the world's lowest cost uranium producer and the uranium producer with the with the lowest capital intensity per pound produced, could decide to increase rather than decrease production and put their competitors out of business. They have the capability of doing that because they're in situ recovery producers. The third thing that could happen is that the pace of Japanese restarts could continue to be slow. You will probably remember that before Fukushima, Japan consumed between 15 and 16% of the world's uranium production. So when Fukushima and the rest of the Japanese nuclear fleet came offline, it reduced demand by about 16% per annum. But more importantly, because the Japanese have a policy of energy security, and because by storing a little bit of uranium, you have the ability to generate a lot of power for a long time, it is estimated that Japanese inventories were between 35 and 40% of total utility inventories worldwide. So at once, with Fukushima coming offline, you reduce demand by 15 or 16% and increased supply by 40%. In the near term, in the 2 or 3 year time frame, the single biggest determinant of the uranium price is going to be the pace of Japanese restarts. And then finally, of course, there's interest rates. If the interest charges go up, that will, if they go up appreciably, and I shouldn't say it will, but it could slow down global economic growth, hence slow down electricity demand, and hence slow down demand for nuclear power, while at the same time slowing down the construction of new nuclear plants, which are capital intensive and require high interest charges.
Rick, summing things up, the U.S. equities continue to zoom ahead, and regardless of the small movements happening in commodities, the commodities relative to U.S. equities are getting cheaper and cheaper and cheaper. When this tide does finally turn at some point, are you confident that commodities will be one of the biggest benefactors just in terms of them reverting back to some type of mean?
I'm not very good at mean reversion calculations. What I can tell you is that bear markets are the authors of bull markets, and we had a spectacular bear market in commodities. Spectacular enough that many of them were produced at costs that exceeded the price that we received for the product, which means that the industries were in liquidation. I said before, Colin, there's 2 ways out of a bear market. One is demand creation, where low prices generate the utility that brings in buyers. A different and messier but more dramatic way to resolve it is by destroying productive capacity. We're destroying productive capacity in oil. We're destroying productive capacity in copper. We're destroying productive capacity in potash, in phosphate, in uranium. It's a messier way to resolve the problem. It takes longer, but it resolves it more dramatically. As to U.S. equities, if we look at the strength as an example in the S&P 500, now it's important to recognize that the S&P 500 is comprised of some fantastic businesses that have increased their overseas sales even in the face of a strong U.S. dollar and generate spectacular profit margins. So they're good companies, but they seem to me to be priced for an economic recovery. If the economic recovery that seems to be factored into their share prices continues, I think a price rise in commodities is absolutely inevitable, although I don't look at any causal connection between high equity prices and some reversion to the mean with regards to commodities. I look to more fundamental reasons for a recovery in commodities. One of the things I've learned for many, many, many years, Colin, is that when the facts line up and the situation is inevitable, it doesn't necessarily make it imminent. So could this take 18 months? Of course. Could it happen in January? Absolutely too.
Well, Rick, your time is always appreciated. I should note that your new set looks fantastic there, and a big congratulations to the man behind the scenes setting that up, Albert Liu. Thank you, Rick, very much for coming back on the show, and looking forward to doing it again.
Always a pleasure, Colin. I look forward to doing it again. And once again, I'd like to offer your viewers the opportunity to email me their natural resource stocks. Please include the name of the stock and the symbol in the text. Email me at contact@sprottglobal.com. I will rank your portfolio, absolutely no obligation, and send it back to you by return email.
Great. Thanks so much for the offer, Rick.
Always a pleasure, sir. Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be? It actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?